The balance does not decrease. It holds. Each month, the number resets to something almost identical. A system built on lending does not profit from repayment. It profits from the continuity of obligation. Interest is not a penalty. It is the product. The borrower is not the client. The borrower is the mechanism. Capital flows toward populations that will borrow often, not populations that will repay quickly. The distinction is structural. The minimum payment option was not designed for convenience. It was designed for duration. A person paying the minimum on a medium balance will carry that balance for years. The institution anticipates this. Debt does not ask permission to grow. It accrues on schedule. The borrower sleeps. The balance does not. Lenders discovered that a borrower who struggles to repay is more valuable than one who repays with ease. The credit line expands, not as reward, as retention. The system widens the channel to keep water flowing. The offer arrives before the need. The institution has modeled the need. It knows when vulnerability peaks. Young persons entering the economy are approved for credit before they have been paid. The sequence is not accidental. The credit score tracks compliance, not financial health. Compliance with the schedule of continued borrowing. A person with no debt history has no score. The system reads absence of borrowing as absence of trustworthiness. To rent an apartment, to secure employment in certain industries, to lease a vehicle, all require the debt record. Participation in the debt system is not optional. It is the price of access to the basic functions of modern life. The rate attached to the loan is rarely the rate disclosed in the summary, compounding lives in the interval. A borrower who reads the full terms has still agreed to them. Comprehension was never required, only signature. The industry expanded fastest in the decade following deregulation, not because demand grew, because supply was released. Regulatory agencies received the data. They also received the projections. The delay in action was deliberate and documented. The consumer protection framework was written after the harm had already been distributed across millions of households. The late fee is not punitive in isolation. Compounded over a missed cycle, it restarts the clock of obligation entirely. Households in persistent debt do not experience it as crisis. They experience it as the baseline condition of living. The normalization of revolving debt took less than one generation. It required no force, only availability and repetition. The industry discovered that shame keeps balances hidden. Hidden balances are not renegotiated. They compound in silence. The counseling industry grew alongside the lending industry. Both were funded by the same institutional architecture. Debt was packaged. It was sold to other institutions. The original lender was no longer present. Only the obligation remained. The borrower receives calls from a collector who holds no original agreement. The debt has changed hands multiple times. The statute of limitations does not erase the debt. It limits collection. The obligation continues to live in the record. Those who study these mechanisms closely often find the same conclusion. The system was not broken. It worked as designed. When regulatory pressure reached a threshold, the industry reorganized. New instruments replaced old ones. The flow continued. The new product was not called a loan. It was called a line. The restructuring was linguistic before it was financial. Student lending was extended into a sector that could not discharge the debt. Default could not end the obligation. The total outstanding student obligation grew each decade without reversal. No policy interrupted the accumulation for long. Medical debt entered the credit system through billing intermediaries. Illness became a credit event. Recovery became a financial one. The hospital's billing department and the credit bureau were never in the same room. They did not need to be. Buy now, pay later products entered markets without classification as credit. The obligation was real. The label was not. The regulator categorized the product. By the time the category was defined, the market had already saturated. The sequence repeats. Low-income households carry higher interest rate. The rate is not assigned by risk alone. It is assigned by position. The geography of lending mirrors the geography of extraction. The same zip codes appear in both categories. Decade after decade, payday lending occupied the space that traditional banking left empty. The rate was extreme. The absence left no alternative. The rollover loan replaced the original. Then the rollover was rolled over. The principal never moved. Only the fee accumulated. Legislation to cap short-term lending rates was introduced multiple times. Each time it failed to clear committee. The record is consistent. The industry's lobbying expenditure increased each year that reform was debated. The correlation was not subtle. Capital moves between institutions before the borrower can dispute the terms. The network is faster than the individual. A generation entered middle age carrying debt from education, housing, and medical events simultaneously. None of it was extraordinary. The net worth of a household in debt is not zero. It is often negative. The system counts this as operational success. The model depends on this condition persisting, not collapsing. The system is not fragile. It is designed for endurance. Reform, when it arrives, typically addresses disclosure, not the rate, not the structure, only the clarity of the obscuring. The debt remains. The lender has changed. The collector has changed. Only the borrower has remained constant in the chain. The system does not require your failure. It requires your continuity. You remain in it. That is enough.